What would you do if the richest people on the planet quietly started heading for the exits, and nobody told you why? Would you shrug it off as noise, or would you stop and ask, what do they know that I don't? Welcome to Finsar, where money isn't just saved, spent, or invested, it's understood. From financial history to modern market truths, we turn real stories into lessons that protect your future. Because right now, in real time, the people sitting on the biggest stockpiles in history are not just trimming a little risk. They are re-unloading at a scale we haven't seen since just before 2008. Jeff Bezos has sold billions in Amazon shares. Mark Zuckerberg has sold billions in Meta. Jamie Dimon, who went nearly 2 decades without selling a single share of JP Morgan, finally sold. Larry Ellison at Oracle has sold. The Walton family at Walmart has sold. Nvidia insiders are cashing out while the stock hits all-time highs. Do you really think that many giants all got diversification urges in the same year? By coincidence? Or is something else going on? On the surface, the explanations sound harmless. Estate planning, philanthropy, tax optimization, normal portfolio management. But ask yourself this. If you were already worth over $100 billion, would taxes be the thing that finally pushed you to sell now, and not any time in the last 20 years? These people could live 10 lifetimes without selling a single extra share. Yet they're selling now, and they're not nibbling, they're dumping. And when you zoom out, the pattern becomes even harder to ignore. Insider selling, the stock sold by executives and major shareholders, has exploded to one of the highest levels on record, second only to the peak of 2007. Back then, the smart money sold into euphoria while everyone else was celebrating the new era. Months later, the floor vanished. The question isn't just, are they selling? You can see that in public filings. The real question is, why are they all selling at the same time? At the same kind of valuations? With the same eerie echoes of 2007? If this isn't random, then what exactly are they seeing in the numbers? And why does the pattern look almost identical to the last time the world's smartest insiders cashed out before everything crashed? Before we dive into names, ask yourself something. If insiders were panic selling, would the average investor even notice? Probably not. Most people only see headlines. Markets hit new highs. AI boom continues. Economy stronger than expected. But beneath those headlines, the people who actually run the companies are hitting the sell button like it is to not own 7 all over again. Insider selling in 2024 hit $464 billion, the second highest level in history. Only 2007 was higher. And we all know what followed. The 2008 financial crisis and a 57% market collapse. But here's the part almost nobody understands. The scale isn't even the scariest part. The ratio is. A healthy market typically sees insiders selling $3 for every $1 they buy, about a 3.1 ratio. That's normal. People diversify, pay taxes, fund family trusts. No big deal. But in 2024, that ratio blew past normal levels and hit 9-1. In some months, 12-1. That means insiders are selling $12 of stock for every $1 they buy. Do you really think people who built trillion-dollar companies suddenly needed cash that badly? Or could it be that they see a risk on the horizon so big that even billionaires want to get out before the crowd notices? Now comes the wild part. It's not random executives from dying companies. It's the most successful founders, CEOs, and operators of our generation. Jeff Bezos, Mark Zuckerberg, Jamie Dimon, Larry Ellison, the heirs to Walmart, Nvidia insiders. These aren't Audit people guessing. They were sitting directly on top of the data pipelines of the companies driving the entire global economy. They know their internal numbers. They know when growth decelerates before it shows up in earnings reports. They know when margins start tightening. They know when debt is quietly becoming unpayable. And they know when valuations have detached from reality. So ask yourself, if the smartest players in the game are selling near record highs, why are everyday investors still buying? Because the moment you look at who exactly is selling and how unusual their timing is, you'll understand this isn't diversification, it's preparation. And what comes next makes the picture impossible to ignore. Here it is a question you need to confront honestly. If the captains of the ships are quietly heading for the lifeboats, why are the passengers still dancing? Because when you look at who is selling, the pattern becomes undeniable. Let S break down the insiders one by one. And you tell me if this looks like normal, routine selling, or a silent alarm only the elites can hear. Jeff Bezos, the man who built Amazon from a garage in 2024 alone, Bezos unloaded $13 billion in Amazon stock. Not 13 million, not 130 million, $13 billion. And the official excuse? Tax optimization after moving to Florida. Really? Bezos has been a billionaire for over 2 decades. He could have moved any year since 2000 to avoid Washington's capital gains tax. Why now? And more importantly, why sell the most when Amazon is at all-time highs? Because insiders don't sell at the bottom. They sell at the peak, right before the air gets thin. Mark Zuckerberg, the emperor of Meta. 2024 was Zuckerberg's biggest selling year ever. He sold around $40-50 billion worth of Meta stock. Meta hit an all-time high above $500, and Zuckerberg sold more shares than he has in almost a decade. Official reason? Funding philanthropy. Again, why now? Why not 2020? Why not 2021? Why only when Meta prints the biggest rally in its history? Because he sees what retail investors don't. AI hype can only push numbers so far before reality pulls them back down. Jamie Dimon, the most important signal of all. Here's the big one. Jamie Dimon has been CEO of JP Morgan since 2005. 19 years. During that time, he never sold a single share. Not one. Until 2024. And how much did he sell? 150 million. The official reasoning? Estate planning. He had 19 years to do estate planning. He chooses 2024 at all-time market highs when he has access to lending data, credit defaults, commercial real estate crash forecasts, and internal bank risk models. Ask yourself, if the man who sees every crack in America's financial foundation is selling, should you really feel safe? Larry Ellison, Oracle's master architect Ellison, sold $3 billion in Oracle stock. At the exact moment Oracle hit peak valuation on AI-driven optimism. He's worth over $150 billion. He doesn't need cash, he needs protection. The Walton family, the owners of Walmart. For decades, the Waltons barely sold anything. In 2024, they sold over $2 billion in Walmart shares. Walmart rarely crashes. It's recession-proof. It's stable. So why sell the safest blue-chip stock in America? Because even Walmart can't outrun a macroeconomic storm. NVIDIA insiders. The AI gold rush kings. NVIDIA had the biggest run of any major company in the modern era, up nearly 400%. And what did insiders do? They dumped over $700 million worth of shares. Jensen Huang himself sold over $700 million personally. If AI is the unstoppable future, why is the man building it selling like the bubble is about to burst? The question you must ask. When the founders of trillion-dollar companies, when the CEOs of the world's largest banks, when the families who built generational dynasties, and when the executives of the AI revolution all sell in the same year, at the same time, at record volumes, is that coincidence, or is that a message the average investor refuses to hear? If the smartest players are cashing out, what exactly are they preparing for? Because the last time insider selling looked like this, the global economy nearly collapsed. Ask yourself this. If you built a trillion-dollar empire, would you sell pieces of it at the peak? Most people say, never, I'd hold forever. But that's because most people don't see what the insiders see. Here's the uncomfortable truth. Insiders don't move based on headlines. They move based on data the public never gets to see until it is too late. And right now, the most powerful CEOs on earth are acting like something big is coming. Take Mark Zuckerberg, the man who controls Meta with iron-tight voting power. Why would someone who never needs another dollar in his life unload tens of billions in shares? Right when his company hits record highs, why sell during abundance instead of waiting for more growth? What internal trends does he see about user fatigue, ad pricing, or AI costs that we won't know for months? Then look at Jamie Dimon, the king of American banking. For nearly 2 decades, he refused to sell even a single share of JP Morgan. 19 years of, I believe in this bank. 19 years of holding through recessions, crises, scandals, and wars. But in 2024, for the first time ever, he sold, not a little, 1 million shares. Ask yourself, what forces a man who's seen every cycle to say, it's time to cash out? What does he know about rising loan defaults, collapsing commercial real estate, and consumer credit stress? And what about NVIDIA insiders, the very team leading the AI revolution? If AI is the future, why are the people closest to the future selling the most? These aren't emotional decisions. These are mathematical ones. These are the signals of people who lived through bubbles and refuse to live through the crash that follows. So here's the real question. If every major insider is selling, what should the average investor be preparing for? Because the answer lies in one chilling pattern, a pattern that last appeared in 2007, right before the world collapsed. Do you want to see it? Here's a question you need to sit with for a moment. What if the same warning signs that flashed before the 2008 crash are flashing again right now? Most people don't look for patterns. Most people don't want to think about risk during good times. But insiders, they live in patterns. They survive by recognizing echoes from the past. And the deepest echo they're re-hearing right now comes from 2007, a year that looked bright, booming, unstoppable, until the floor disappeared. Back then, something strange happened. CEOs, founders, and boards quietly began selling stock at a scale nobody had seen before. Not retail investors, not small players, the giants. The ones with access to internal data, banking reports, loan performance, and macro stress signals hidden behind corporate doors. They sold while the public celebrated. They sold while the media cheered. They sold while the markets broke new records. And 12 months later, the global financial system imploded. The pattern was so clear in hindsight, mass insider selling was the smoke before the fire. Now look at today. Does it not feel eerily similar? Insider selling in 2024 and 2025 has reached levels almost identical to 2007. The sell-to-buy ratio is beyond extreme. Executives who held for decades are suddenly unloading. Billionaires who could hold forever are stepping aside. And we are forced to ask ourselves, are they merely diversifying or quietly escaping? When the smartest players in the world make the same move at the same time, shouldn't that make us pause? Shouldn't we wonder what storm they see approaching? Because patterns don't lie. Data doesn't lie. Behavior doesn't lie. And every time insiders have sold at this scale, a major market correction or full-blown crash has followed. The question isn't, is a crash coming? The real question is, how close are we to the edge? Because to understand what happens next, you need to see the hidden signals insiders use, the signals that reveal when a market is moments away from breaking. Ready to see what they're seeing? Ask yourself this. If the people who built trillion-dollar companies are quietly heading for the exit, what exactly are they seeing that you aren't allowed to? Because insiders don't sell billions because of fear. They sell because of information, real information, the kind that doesn't show up on CNBC tickers or quarterly reports, the kind buried in spreadsheets, credit models, internal dashboards, and private economic stress tests. The public gets headlines. Insiders get the truth. Think about this carefully. Jeff Bezos knows Amazon's real sales trajectory, not the polished numbers, but the raw internal trend lines. He knows where demand is slowing before the world knows. Mark Zuckerberg sees internal advertisers spending patterns, real engagement metrics, the real cost of training AI models, and the decline curves that never make it into press releases. Jamie Dimon sees the credit risk data from JP Morgan's loan book, rising delinquencies, weakening consumer health, deteriorating commercial real estate valuations, the kind of data that predicts the future months before the public even senses a shift. These men aren't guessing, they're reacting. And here's the disturbing part. All of them, across different industries, saw the same thing at the same time. Tightening liquidity, slowing growth, persistent inflation, weakening corporate margins, record leverage, and valuations that only make sense in fantasy, not reality. They didn't wait to see what happens. They acted. They sold. So ask yourself another question. If these insiders believed the market still had years of growth ahead, would they really be selling at these levels? Would they risk missing out on trillions in upside? Or does their behavior reveal something far more serious, a message they won't say publicly but are screaming through their actions? Because when insiders sell, they aren't predicting the market. They're protecting themselves from it. But what exactly are these insiders reacting to? What data is so alarming that it pushed billionaires to cash out? The answer lies in a set of indicators that have predicted every major crash in history. And right now, every single one of them is flashing red. Ready to see them? Here's the real question. What happens when every major economic warning system lights up at the same time? Not one, not two, all of them. Because that is what insiders are looking at. Indicators with decades of perfect accuracy suddenly pointing toward a single outcome. And when history starts repeating itself this loudly, only fools ignore it. Start with the Buffett indicator, the ratio that compares the size of the stock market to the size of the actual economy. Warren Buffett himself called it the single best measure of market valuation. Historically, when this indicator rises above 120%, danger is coming. Today, it's sitting around 185%. That means the market is priced almost twice as high as the real economy can support. Ask yourself, how long can a system float that far above reality before gravity pulls it down? Then look at the Shiller P/E ratio, a measure of earnings stretched over a decade to remove short-term tricks and illusions. Its historical average is 16, cheap is 10, expensive is 25. Right now, it's hovering in the mid-30s, the same territory we saw during the dot-com bubble right before the market collapsed. Why are investors paying double the normal price for every dollar companies earn? Because hype has replaced logic. And then there's the monster nobody talks about until it's too late. Leverage. Margin debt, the money investors borrow to buy stocks, is near all-time highs. Leverage works like gasoline. It makes the fire bigger when things are good, and catastrophic when they turn bad. What happens when stocks fall and millions of investors get margin called at the same time? forced selling, and forced selling drags everything down like an anchor tied to the entire market. Now ask yourself the simplest question of all. If these indicators have predicted every major crash for decades, and they're all flashing red together, what do you think comes next? But valuations and debt are just the surface. The real danger is hidden deep inside the corporate world, in balance sheets that can only survive high interest rates, and in a debt bomb set to explode over the next 2 years. If you're ready, let's open that vault. Here's a question most people never ask. What happens when the entire corporate world has to refinance its debt at double or triple the interest rate? Because that's exactly what's unfolding right now. Quietly, mechanically, and inevitably. This isn't a prediction. This is math. Over the last decade, companies borrowed trillions when interest rates were nearly zero. Debt was cheap, capital was infinite, and everyone assumed the low-rate world was permanent. But now, those loans are maturing. And refinancing at 7% after borrowing at 2 and 3% isn't a small adjustment. It's a death sentence for thousands of companies. Ask yourself, how many businesses do you know that can suddenly afford double their monthly payments? It's already happening in commercial real estate. Buildings bought at peak prices with cheap loans are suddenly worth 40% less. Offices sit half empty because remote work never reversed. And when owners try to refinance at 8%, the math fails instantly. So they walk away, literally handing the keys back to the bank. Do you think banks can survive waves of billion-dollar defaults? Especially regional banks with 20, 30% of their loan books tied to commercial properties? And this isn't just real estate. Corporate debt, over $12 trillion, maturing through 2025 and 2026. Many of these companies can refinance at current rates. So what happens next? Defaults rise, bonds collapse, credit spreads explode, and stocks, which rely on stable financing, fall like dominoes. What makes this even scarier is who sees this first. CEOs, CFOs, bank executives, the insiders who understand their balance sheets better than anyone. They know which companies can't survive refinancing. They know the exact month cash runs out. They know which industries are already bleeding. And they're selling their stock before you see a single headline. If the people who built these companies are running for the exits, shouldn't you at least be asking why? But debt isn't the only crack forming. Another sector is already collapsing from the inside, and it's the one holding up America's entire financial system. In the next part, we step into the disaster zone, commercial real estate, and the coming bank fallout. Here is a question that should make you uncomfortable. What happens when the buildings holding up the banking system stop paying for themselves? Because that's exactly what's happening in America right now, quietly, invisibly, and far faster than the public realizes. People think a housing crash is the threat, but no. The real danger is towering over empty streets, commercial real estate. Walk through any major city today, New York, San Francisco, Chicago, and you'll see the same eerie pattern. Entire office floors dark, buildings half empty at 3 p.m. Companies that once leased 5 floors now lease 1 or 2. Remote work didn't temporarily change the model, it permanently changed demand. But here was the real question. What happens to a skyscraper bought at a peak price when half its tenants disappear? Its value collapses, sometimes by 30%, sometimes by 50%, sometimes more. And these buildings carry massive loans that were taken when interest rates were 3%. Now those loans are maturing. Refinancing at 8% doesn't just hurt the numbers, it destroys them. The owner can't cover the payments, the bank won't refinance at a loss. So the owner does the unthinkable. They simply walk away. They hand the building back to the lender. This creates the next shockwave, regional banks. Most Americans don't know this, but regional banks hold a huge portion of commercial real estate loans. They're heavily exposed. When an office tower defaults, the bank takes the hit. But when 10 towers default, 20, 50, these banks face losses they cannot absorb. They fail quietly at first. One collapse here, one there. But eventually the cracks spread, just like in 2008. And guess who already knows this is coming? Jamie Dimon, the man who runs the largest bank in America. He sees internal default data. He knows which buildings are underwater. He understands what happens when trillions in commercial mortgages mature into an 8% world. And he's selling his stock for the first time in 19 years. So ask yourself, if the man who knows the banking system best is cashing out, what does he see on the horizon? Because the next part exposes the final domino, the one that threatens the entire country, the government debt spiral. What happens when even governments can't pay their bills? Let me ask you something unsettling. What happens when even the government or the institution that prints the money can afford its own bills anymore? Because that's not a theory. That's the mathematical reality the United States is sliding toward quietly and rapidly. And unlike 2008 or 2020, this time there's no easy bailout, not when the government itself is the one drowning. Right now, the US is spending $2.4 trillion more than it collects each year. Not 100 billion, trillion. It's like a family earning $50,000 a year, but spending $80,000 and putting the rest on a credit card that already has a huge balance. Eventually, that card maxes out. But here is the shocking part. The government doesn't have one card. It has 38 trillion of them. That's the national debt. And rising. But the real horror isn't the total debt, it's the interest. For decades, the government borrowed at 1 to 2% interest. Now, rates are 5 to 7%. And just like corporate debt, government debt must also be refinanced, which means the cost of borrowing has exploded. Interest payments alone are now $1.2 trillion per year, more than the US spends on its entire military, more than Medicare, soon more than Social Security. Ask yourself, how does a country survive when simply paying interest becomes its largest expense? There are only 3 options, and every single one is ugly. Raise taxes dramatically, kills growth. Cut spending violently, politically impossible. Print money to fill the gap, inflation, currency collapse. Which one do you think politicians will choose? And which one protects your savings? And which one destroys them? The insiders already know the answer. They know the debt spiral has no soft landing. They know inflation is not over, it's waiting. They know the US will eventually have to devalue the currency, because that's what every empire does when debt becomes unmanageable. And that's why they're selling now while their wealth still holds its value. But here's the real question. If the currency weakens, what actually survives? Your stocks? Your savings? Your retirement? Or something else entirely? In the next part, we uncover the warning sign every insider watches. A signal that has predicted every recession since 1950 with 100% accuracy. And today, it's flashing bright red. Have you ever wondered why every major crash catches ordinary people off guard while insiders walk away untouched? Why the public always hears everything is fine, right until the moment everything burns? The truth is simple. Crashes don't destroy wealth, they transfer it. And the people who lose the most are always the ones who believe the system the most. Because when the markets start falling, who gets hit first? People with 401ks, retirees, middle-class professionals, anyone whose savings live entirely inside the system. They don't get advance warnings. They don't get private data sets. They don't get algorithmic forecasts. They only hear the truth when it's already too late. Meanwhile, the insiders, the same billionaires quietly selling today, have already moved to cash. They already rotated out of risk. They already protected themselves long before the storm even formed. So ask yourself, if the people who built these companies are running for the exit, what do they see coming? Because when the crash begins, it doesn't move slowly. It cascades, margin calls, forced liquidations, algorithmic selling, panic. And in those moments, your emotions become your greatest enemy. Will you freeze? Will you panic sell at the bottom like millions always do? Or will you be the one person who prepared while there was still time? Most people won't. Because most people believe this time is different. But insiders know the truth. No bubble survives reality. If the smart money has already stepped off the train, what happens to everyone still on board when the brakes fail? Have you ever wondered what a financial storm looks like before it hits? Because right now, we are in that silent, deceptive pause. The moment when everything feels normal, the market still looks strong, and everyone convinces themselves nothing bad is coming. But if insiders are running for the exits, what do they see that you don't? Look around. Corporate debt is cracking. Commercial real estate is sinking. Regional banks are wobbling beneath the weight of loans they can't refinance. And yet, the average investor still believes everything is fine. Why? Because denial is always strongest right before a collapse. History tells the same story. Before 2008, before the dot-com crash, before the Asian financial crisis, the warning signs were everywhere. The insiders saw them, the institutions saw them. But the public held on until the last second. Are we repeating that exact psychological trap again? Right now, the global economy is sitting on a table with one broken leg. Every CEO selling stock knows that when the table falls, it won't fall slowly. It will snap all at once. So the real question is, are you preparing like the insiders or hoping like the crowd? Because if the billionaires have already taken cover, what happens to the people still standing in the open? Let's keep going. If the smartest people in the world are quietly stepping away from the table, why are you still sitting at it? The billionaire exodus isn't just a headline. It's a map, a signal, a pattern humanity has seen in every major financial collapse of the last century. And now you have to ask yourself, are you preparing or are you hoping? Because hope has never saved anyone in an economic storm. Look at the data you've seen. Look at the insider sales. Look at the debt, the bubbles, the leverage. If the people who built trillion-dollar empires are getting out, what does that tell you about the system the rest of us are trapped inside? And if they're preparing for impact, why aren't you? This moment will split people in two. those who panic, and those who position, those who lose, and those who accumulate, those who freeze, and those who move. So ask yourself clearly, when the crash hits, will you be a victim or a strategist? Will you cling to inflated assets or hold cash when everything goes on sale? Will you react too late or act before the crowd wakes up? Because the people who come out rich on the other side aren't caught lucky. They were early, they're aware, and they refuse to pretend the danger isn't real. This is the final chapter of the warning. But what comes next is your decision. If you're ready to see exactly what survives when everything else collapses, then don't miss the next video. What survives when money fails? The collapse nobody thinks will happen again.